Hello, dear friends. It's Jonathan Rose, and welcome to Masters in Trading Live. How's everybody doing out there? We get on live every single day, 11 o'clock Eastern Time. We go over the market, and every single day, we're going to share our very best trade. Today, I got an awesome trade for you. I am so excited for you to see this trade, so hang around to the end. I also added the email list. I also added our contact information underneath. Contact at Masters in Trading. I've got some awesome feedback from some of you guys. Send something in. Feedback, the good, the bad. What can we work on? I value your feedback. Today we're going to talk about 4 things. CPI came out. Let's talk about CPI. Let's talk about the Fed. CPI adds volatility. This morning we're seeing the short-term VIX spike. Let's go over that. $7.7 million trade. This is going to be the trade of the day, and it's in a leveraged cannabis company that continues to buy swaps. That's high risk. Let's go to the charts. Let me show you exactly what I'm talking about. So let's start here because we're going to first talk about Fed and CPI. So let's just get here. Let's go. All right. So let me start here with a little lesson on quantitative tightening. Quantitative tightening is a contractionary monetary policy that's the reverse of quantitative easing. The government bonds and other assets that central banks have bought from the market through QE programs are held on their balance sheet. Now, some of you might have known or realized that originally there was quantitative easing. Okay, quantitative easing injects liquidity into the market, increasing the monetary supply. Okay, so when we had quantitative easing, what did the market do? Right, they were literally creating money. The market just went up, 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 up because they're creating money. Quantitative easing. Well, the opposite of quantitative easing is quantitative tightening. But therefore, Jonathan, if the market goes straight up for quantitative easing, why isn't it going straight down for quantitative tightening? So quantitative tightening removes liquidity, decreases the money supply by selling government securities. But it's often interpreted as a response to a strong economy. And remember, the Fed is raising rates during this quantitative tightening cycle. So it's peculiar. Quantitative easing, market goes straight up. Quantitative tightening, market's going up once again. But what can we watch? How do we know when risk is elevated? Well, last week we talked about our key line in the sand. And the line in the sand is one number, line in sand. And it's one number. And that one number, when the market's underneath, we're bearish price, but we're bullish volatility. Okay, price, but we're bullish vol. If we're above the line in the sand, bullish price, bull price, and this is bearish vol. Why? Because there's no uncertainty up here. The uncertainty is all to the downside. What I want you to look for is look at this. We ain't going anywhere. There's just a lot of nothing going on in the market. But we do want to focus on that line in the sand. And so for the line in the sand, the key levels, and this is a weekly, that's why I pointed to a weekly. And we talked about key highs and key lows. And so the lows is going to be all of these lows right here. Boom, 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 boom. Nice and tight. There's really not very much going on. Now, common sense would tell us strong market, but we can't pull back at all, right? Strong, strong, strong. This market is strong. There's not much of a pullback, but these are the key numbers that I want you to watch. Looking at the market right now, it's 437. Qs are trading at 437. We are above the line in the sand. It sounds weird. Market's pulling back. There's support right here. This is how we can follow VIX term structure and trust if the market's going to pull back or if the market's going to rally. Okay? VIX. VIX is a measure of uncertainty. The higher the VIX, the more bearish. When the VIX, which is right here, this is a 30-day measure of volatility. 16 is really low. It just is. It's super, super low. But what we want to do when we're looking at this VIX term structure is we could look at risk over time frames, right? So look, this is the VIX 9D right here. This is the VIX 1 year right here. Now, volatility in the next 9 days, or do we have volatility a year out? When the market's going to fall, you're going to see VIX 9 spike. That's what's going to happen. So look, earlier this morning, when I was preparing for this presentation, I did a little printout, VIX 9D, 1631. Right before I hopped on, VIX 9D, 1513. Okay, market is going to rally. Right now, VIX just rallied, VIX 9D rallied again. Market's pulling back. Focus on VIX term structure. When it looks like this, and the 9 day is chilling, and a 1 year out, the market's going higher. What we have to watch out for is this. We don't want that VIX 9 day spiking, because then the market's going to go down and risk is certainly elevated. Oftentimes you'll catch me saying, hey guys, we want to build our memory bank. This is something we see over and over and over again. Well, guys, this is something we need to build our memory bank because this is something that happens over and over and over again. Oh, do I have an advanced notice trade for you? I am so excited about this one. Let's get into it. MSOS. MSOS is a cannabis ETF. Okay? I looked at all the flow, all that option flow for 2024, starting January 1st, right now to April 10th. The biggest order that MSOS has seen all year was yesterday, April 9th. It was done in the May expiration, and somebody traded 29,522 option contracts for a grand total of 7.7 million smackers. This is the premium traded all year. Second was $472,000 trade. Can you see why this is such a big trade, guys? 7.7 million. Let's look into it though. What did they do? Here's the trade, 7.7 million in MSOS. The trade was done at 10:08 Eastern Time. Okay, 10:08 Eastern Time. I'm on Central. That trade was done right here. So as soon as somebody did a trade for $7.7 million, MSOS got crushed. This was a very bearish trade. We can see that from the 1 minute behavior of the stock. Because it's sold off, bit longer explanation, but give me the benefit of the doubt. This is a very, very bearish trade. What can traders do? How can we capitalize when we see a trade like this? Now I take you to the trade of the day because I'm going to show you exactly how we capitalize on this sucker. MSOS Holdings. MSOS is an ETF, a cannabis ETF. So the first thing that I wanted to do when I saw this big trade is let's look under the hood. What's MSOS holding? And so when I looked under the hood and I wanted to see what they were holding, they own like all the liquid cannabis companies. Okay? Green Thumb, Curaleaf, Trueleaf. But what I found incredibly interesting is they don't own the stock. They're forced to own swaps. I think they might be forced to own swaps because maybe they can't hold the stock. I don't know exactly, but swaps are more risky than the equity. That's weird to me. Why are they only holding swaps and not holding any of the underlying stock? Swaps are going to have more risk and less liquidity than the actual equity. Is that why somebody's got a $7.7 million trade? I don't know. But then I dug into it a little bit deeper. And we look at these. This is called divergence trading, relative value trading. We have MSOS, and then the two biggest holdings within that ETF, right? So these two are in MSOS. So wouldn't you think they're going to move together? I certainly would. They do. They move together. Here they start breaking off, right? Okay, they come back together. But now we are really, really lagging. MSOS is really strong. The trade that I like, I don't want to buy this cannabis company. I don't know very much about it, but I do want to follow that smart money, placing a very big bet that MSOS trades much lower. So let me take you there. MSOS. The trade that they did is right here. Now, they did a trade that was in the money. I wouldn't say it's deep in the money, but it's definitely in the money. Interestingly enough, the premium in this 12 strike is going to be the same as the puts. For those without options training, that might be a little bit advanced, but these 12s right now, if you do 12 minus 993, that equals 207. 207 is the intrinsic value, and the amount of premium in this is about, so 207, about 59 cents of premium in this. That would value these at 59 cents. I know this is getting a little bit advanced, but slow down, because the trade that I'm going to share, I'm going to write it out right here. I like buying puts, and I like buying puts. I want a little bit of meat on the bone. So I want a 30 delta. Now you can use delta, a little cheat sheet, is the percentage or the likelihood that this ends up in the money. So the market is saying, hey, MSOS has a 30% chance of trading under 9 by expiration. Watch that again if you need to. MSOS has a 30% chance of trading under 9 by expiration. I don't want to do the deep in the money stuff. I'd rather do this. So buy puts, let's do the 9 strike, and I like them for 71 cents. That is $71 of risk for 30 days. You can never lose more than you are willing to bet. If you do a 10 lot, that's $710 of risk. Now, hopefully you can see when I jumped on, I was super excited about this trade. What made me so excited about it is 7.7 million was just done yesterday. 7.7 million in premium. The last 4 months throughout the whole year, we haven't seen a trade bigger than $450,000. When I looked under the hood, I was surprised to see all those swaps, all that illiquidity. So maybe somebody's making a big bet on the downside. My name's Jonathan Rose. Every day we get on here live. I'm a big believer. The creative trader wins. Trade smart. I'll see you tomorrow live, 11 o'clock.